Thank you, Mr. Mobius, for accepting the invitation of ING Bank to speak to us here in Ostrava. We're very happy to have you on the video, and we're very happy that you have the opportunity and the time to speak to our clients, because I'm sure they'll have a very interesting insight into what you do at Franklin Templeton and what your views are. So let me start with the first question. You've just celebrated 30 years with Templeton Emerging Markets Group. What are you most proud of, and what has been the greatest challenge you've encountered over the last 30 years?
The most proud aspect of what I've been doing is the growth of the funds under management. Because when we started in 1987, we had only $100 million. Now we have 28 billion. So the growth has been tremendous. However, the greatest regret is that we haven't kept up with the whole industry in terms of market share. Our market share has been very, very low because the whole industry has grown tremendously. So you're talking roughly $1 trillion in emerging market funds. So in some ways, I was a pioneer, so I got everyone else going, but I didn't catch up with the rest of the group.
Well, in that respect, where do you see the emerging markets group moving in the future? What's the prospect for the emerging markets and for the group as such?
The prospects are really good because we now have a new category of nation called frontier nations. And these are countries that are really at the beginnings of creating market economies. You find a lot of countries in Africa, many countries in, here in Eastern Europe, Romania would be considered a frontier market, and in Asia. So there are lots of opportunities there for growth because you're talking about 30, 40, 50 countries that will eventually be coming into the market economy arena. And that's going to be very, very exciting.
How big is the investment universe that you have now in your funds? How many countries?
Right now it's 70 countries.
70 countries.
So we can increase
you still have space to
coverage,
grow.
Yeah.
Many people feel that investments into emerging markets assets are high uncertainty venues or higher uncertainty venues with a not so small risk of losing the money invested as compared to investments into the developed markets assets. What's your take on it? And how do you deal with these arguments and opinions that people might present to you?
Right. Well, first of all, I point out to people the facts. The facts are that if you had invested in emerging markets in 1987 and put an equal amount into the developed markets, the emerging markets portion would have grown maybe 8 times more than the developed countries. So that's proof that going into emerging markets can be very, very profitable. However, there is also volatility in every market, whether it be emerging market or developed markets. You're going to have some kind of volatility. So you could lose money if you buy at the top of the market and then sell at the bottom. That's the reality. And that's the reason why we encourage people to cost average, buy over a period of time. But that's one thing. The other thing that people worry about is currency. And it's true that currencies in emerging markets can go up or down. For example, the last 3 years, emerging market currencies were depreciating against the euro and the US dollar. Now, many of them are appreciating. So there's profit to be made even in the currency side of things. So that's an aspect that people forget, that there are opportunities when you see this kind of volatility. But also, what I try to point out to people is that emerging markets are growing about 3 times, almost 3 times faster than developed countries. Of course, that will be reflected in the profitability and the growth of their companies. Again, another reason why investing in these companies is very, very good.
Plus, I guess, last but not least, is the demographics that's playing in favor of the emerging markets. Maybe going back to those 30 years you spent with Franklin Templeton, what is your core investment philosophy? How do you approach investments in emerging markets?
The core investment philosophy is to look for undervaluation. In other words, with the fluctuations of the market, it's very important to look for situations where a company or country is unpopular for one reason or another, but where the fundamental profitability or growth of a country or company is good, and you buy at that time. So the search for undervaluation is really the key to successful investing in our view.
Has this strategy or this philosophy developed somehow over the last 30 years you've been with Franklin Templeton, or have you always been, favor of this type of investments? Because obviously even the emerging markets have developed as such over the course of time.
Well, we adopted that as a result of being part of the Templeton Group, because Sir John Templeton was a pioneer in global investing, and he believed that value investing is the way to go. And value investing really means finding underpriced companies. That is really the fundamental core of what we do. Now, how to do that is the next big question, because you have to look at many, many factors. And one of the most important factors are the people behind the company. What is the background of the people?
Well, I have a specific question on this, because it says, the process of gathering data and market intelligence in developed markets versus the emerging markets is obviously different. How much weight do you put on personally visiting the company, speaking with the management, speaking with the supply chain, maybe even speaking with the employees of the company? And how reliable are these, personal insights versus publicly available financial data versus, say, public sources and media?
You have to use everything you can get, and meeting people personally can be very revealing, particularly if you can meet them in the environment where they're working. So you're not only observing them and talking to them, but talking to the people around them. So you get an insight into the culture of the company and what their vision is, etc. However, of course, the published material is also very important, because very often you can read something in the internet or the press which gives you another insight into a company. The company accounts are very important, of course, because you have to look at the audited statements, what is the balance sheet, profit and loss statement, so forth. So I think you have to use a plethora of information. And unfortunately, we never have enough information. We always want more. But you have to make decisions sometimes on incomplete data.
Where do you think the emerging markets are today as compared to the past? And where do you envisage them to be, say, in 10, 15 years? Will they be as exciting and as interesting arena as they are now?
They'll be more exciting. And the reason why is that back in 1987, the share of market capitalization, share of trade, of GDP, was about 20% of the world for emerging markets. Now it's something like 40%, and will be going higher. Eventually, emerging markets will surpass that of the developed markets in terms of trade, GDP, and market capitalization of the stock markets. So that's the direction where we're going.
ING Bank offers its customers the possibility to invest into Franklin India Fund. So the next question is obvious. Where do you see the investment catch in India, and do you think it can be one of the emerging markets of the future?
India, definitely. India is now the fastest growing major economy in the world today. Now it's smaller than China, but it's growing at a faster rate. And the reform program instituted by Mr. Modi will be very, very exciting for the country going forward. It will be able to reform a lot of things that are holding back companies to grow.
So, you bet your own money on India?
Oh yeah, definitely. We are.
Okay. Where do you see the biggest opportunities and maybe the biggest risks, in emerging markets? Because, as we said in the beginning, the facts are speaking in favor of emerging markets, but obviously there are risks. So yeah. Where would you see the risks, in particular this time, or maybe in a few years' time?
The big risk, first of all, would be geopolitical, some strife geopolitically. For example, India going to war with Pakistan, or China having a problem with the US. And you can name a whole list of possibilities like that. But overarching everything is the nuclear risk, because nuclear proliferation and the chance of a nuclear accident are very, very high at this stage. So that's something that is covering not only emerging markets but developed markets. In emerging markets, more specifically, it would be the risk of violent political change internally. Because with the internet, information is flowing much faster and to more people in these countries, which is resulting in a desire and demand for political reform. And if that reform does not come, then there could be repercussions, violent repercussions.
Do you think one of the risks might be the Trump presidency in the US and the rhetoric towards some of the developing or emerging markets? And what's your personal take on potential effects of the policies that President Trump is at least saying to be instituting towards some of the markets?
Well, you must remember the prime objective of President Trump is to grow the American economy by getting more exports, providing more jobs for Americans and so forth. If he is successful in that, it's very good for the whole world because the American economy is the largest economy in the world. If that economy grows, that impacts globally because America is a big exporter and importer, so that the repercussions are very good. So overall, I think the Trump presidency could be very, very positive. Of course, there's certain areas where he'll say something which upsets people. He'll say something about immigration, or he'll say something about Mexico or about China. But if you observe very carefully, what he says and what he does are two completely different things. For example, he says some bad things about China, but he's now going to sit down with the president of China and iron out these issues. So a lot of his behavior will be more bilateral negotiation and making deals. This is what we see going forward.
Speaking of China, I read one of the blogs that you posted on the shadow banking in China and how it may not be as dangerous as some media might portray. How about the growth of the corporate debt in China? Is that a risk, or is that something to be concerned with, or not?
There's no question it is a risk, and something we look at very carefully when we look at Chinese companies. What is the debt picture? Now, of course, if you're dealing with a government-owned company, that's a critical part of the Chinese economy, such as Chinese Aluminum Corporation, Chalco. They can get into heavy debt, but they're not going to go bankrupt because they're being supported by the government banks. But if you have a totally private company, then they could get into trouble. And many of them do. I mean, it's a big country and people are going bankrupt every day. There's problem. But I think a lot of Western observers make the mistake of projecting let's say, the US view on China. And if you do that, you're going to make a mistake because China is a planned economy. The main pillars of the economy are controlled by the government. The 4 major banks controlled by the government. The major industries are controlled by the government. So they can coordinate a lot of things that the U.S. economy or the U.S. government can't. But even in the case of the U.S. government, they bailed out the banks in America. So this is what we see with China.
So basically, maybe we're going back to one of the questions I asked in the beginning. It's the hands-on experience on the ground with the companies, with the governments, with the government officials to basically get the insight. What is your personal investment credo?
My personal investment credo is, first of all, be diversified. Because no one knows what any individual country or any individual company will do. And very often they will make mistakes and it'll look very bad. So if you're not diversified, you stand too much of a risk. So that would be one very important point. The second thing is be in equities to a greater extent, because equities will tend to adjust for inflation. And the third thing is, look for value. Don't buy when everybody else is buying. That's when you should be selling, and you should sell when everybody else is buying. I mean, this is really the most important lesson that we've learned.
Understand. We're in Ostrava now, Czech Republic. Do you, or would you regard Czech Republic still as an emerging market, or is it in the developed arena, or has it disappeared from your radar completely?
It's an emerging country. And it's simply because of, but it's very close to becoming into the developed area because this is all based on per capita income. So if you look at the World Bank list of high, middle, and low income, Czech Republic is in the middle income. So, but that can change, you know, as the country develops, it could move up into high income.
And how about the neighboring countries, Poland, Hungary?
Same, Poland, Czech Republic, Hungary, Slovenia, these would all be...
Slovakia as well?
Yeah, these would be all in the emerging country.
Maybe one of the last questions that would sort of tie it up. What are your views on ETFs? Where they fit in the regular portfolio, and how is going to what's going to look like the market ETFs versus but plus the actively managed funds in the future?
Sure.
You know,
ETFs have been growing at a very fast pace, and this ETF is attractive from very many aspects. First of all, they track an index. So a lot of people who don't want to make decisions say, look, I'll do what everybody else is doing, I'll follow the index. The second thing is that there is a tax benefit for US investors. And the third thing is that from the management point of view, you don't have to worry about redemption because the ETF shares are traded in the market. So there's no pressure on the manager to worry about the redemptions from the people. But the disadvantage, of course, and by the way, ETFs have been taking a bigger share of the total market. But what's happening now is that the active managers are being forced to really be active, be different from the index. Because in the past, a lot of active managers tracked the index because they didn't want to be underperforming an index. Now they're being forced to separate or lower their fees because the other advantage of ETFs is that the fees are lower. So what we're getting now is a divergence between these two groups, and there will be a good opportunity for active managers because as more and more people follow an index, there's a great opportunity for non-index stocks. So active management will be alive and well for many years to come.
Well, I think it's the most optimistic ending we could have to this interview. So
thank you.
I thank you very much for taking your time and speaking to ING Bank and to our clients and people who follow ING and invest with ING. Thank you once more very much for all your time, for all your answers, and hope to meet again in the future.
Thank you very much.
Thank you very much.
Thank you.